Hello, I'm Randy Williams, proud member and founder and CEO of Keiretsu Forum. This is our 10th month of producing shows, content-driven, trying to inspire our viewer on angel investing. One thing unique about Keiretsu Forum, we have grown to 46 locations globally. We've always loved real estate. Even though we have funded over 1,000 companies, we still enjoy the safe harbor aspects of real estate. We try to hit singles and doubles. And so we're going to talk about the risk coming up. We're going to talk about the possible storm clouds. We're going to talk about opportunities. I'm very, very fortunate to have on my show Matt Burk, CEO of Fairway America. Matt is also a partner in our current fund. We have top-off funds at Keiretsu Forum. We're not going to necessarily be talking too much about the funds and the activity. Certainly like to talk about, I think, some of the great results we're getting, but I want to talk about what we're going to be looking at next couple of years. This is 2016 in Silicon Valley. We're taping this. What's going to happen in 17, 18? So Matt, why don't you talk a little bit about your background, and then we can dive into risk and opportunities of real estate investing.
Sure. Well, thank you, Randy. My background is in the real estate finance business. I've had Fairway America since 1992. Done more than 1,000 small balance real estate deals. A great many of them have been loans secured by commercial real estate. So I've got a large background in real estate finance. I've set up and run 7 pooled investment funds during that timeline, and we also help people around the United States set up their own pooled investment funds. So we use small balance real estate entrepreneurs around the country in a variety of different asset classes. If they are interested in setting up a pooled investment fund, we can help them do that. And that really is our origination source to find people that we invest in alongside around the United States. So that's a little bit about my background.
So let's try to stay at 30,000 feet for a while, and then we can drill down on specifics. The topic about risk and opportunities, but just some full transparency. I'm a happy investor. I've been investing, I think, 4 or 5 years in your great company, and also now we've created a partnership where we're topping off some of our. Well, we're topping off tech funds, but in the real estate sector, which you're running for us, tell us about our relationship in regards for the viewer, what we're doing with Fairway America and Keiretsu Forum.
Well, I think that it's a great example of the kind of thing that we do. My involvement in Keiretsu the last 5 years as we've gotten to know each other is, I know you've had a desire to set up a real estate fund. We helped architect and create the structure of that fund and have come in a partnership. Our role in that whole thing is doing a lot of the origination, the underwriting, the due diligence, the portfolio management on the real estate side, and picking and choosing the investments that go into the fund. Of course, yourself and myself and Nathan and Darius on the investment committee, but really on the origination, the underwriting, and the asset side of the equation.
So then let's dive into it, because we've already made 5 investments together, and the return has been spectacular, between 12 and 16%. And there's no promise on future returns, but let's talk about what we're investing in. And I want to have a wonderful, healthy debate, but a lot of them in secondary, tertiary markets. It's hard to get certain returns in very primary markets. So what are the asset classes that we're investing in?
Well, I think if I had to say, the most common underlying theme for us is that we deal with non-institutional sized real estate deals. So I think when a lot of people think of real estate, they think of downtown office towers in San Francisco, retail or regional shopping malls and things of that nature. That's really not the kind of thing that we do. We are involved with all manner of real estate people who have different strategies around the country. So many of these people, as you say, are in secondary and tertiary markets. I mean, we have clients in Columbus, Ohio, and small towns in Texas, and we've got clients in Boston and San Francisco and so forth, but the investments that we're making are largely in markets that are not as high-flying, let's say, as San Francisco. When people think of things that are at 3 and 4 cap rates and Class A office buildings and so forth, that's really not what we're doing.
Okay, so I roll the dice in a lot of different asset classes. Probably 10% of my portfolio is in the public markets, and the rest is in tech investing and real estate. And ironically, my investment manager at a very large iBank is thinking about coming into the real estate fund because he just can't get the returns we're getting. He's delivering me 1 or 2%, and with some risk. So how are we getting our returns? So let's talk about asset classes first. Are we not a lot of construction risk we're going after, but we're going after multifamily. Tell us about the asset.
Well, we'll do some. We don't do really any ground-up construction. I mean, I would say that one of the things that we look for, as you said, singles and doubles. I'd much rather invest in things that have fundamental cash flow oriented investments as opposed to things that are highly speculative. Obviously, if you're in a good market, like the last 5 or 6 years, the market's been going up and up and up. So pretty much everybody who's been in the real estate space has been very successful for the last several years. As you say, there are storm clouds on the horizon. I mean, I'm seeing things in some of the primary markets, particularly San Francisco, Seattle, Miami, New York. Some of these projects are starting to come to a halt. You're seeing more rent concessions. You're seeing higher, not so much higher vacancy yet because they're still filling it up, but they're giving away more. So, I mean, I like to stay in things, value investing is what I would call, right? Is that if people can, our sponsors or real estate entrepreneurs make money on the buy. If you can buy for less than replacement cost, if you can buy things that have good solid cash flow and still have good upside in them, that's the kind of thing that we look for. And I know that you're a big fan of that type of an investment as well. If you're not taking that kind of risk, we seem to be able to get that much more frequently in markets like the Midwest. For example, we have several deals in Kansas City and Chicago, Toledo, Ohio. I mean, these are not sexy markets from the standpoint of people, especially here on the West Coast, but they're solid cash-on-cash returns, and in my opinion, they're just less volatile.
So let's just say there's going to be a recession.
Well, there will be, and there's going to be at some point.
Not tomorrow, next day. It could be 2018, 17. So let's just say there's a recession, and obviously, especially my members, I have over 3,000 members worldwide. We want to get our principal back.
That's right.
And after that, we like to have a risk-adjusted return. We like singles and doubles. So historically, in Northern California, I'll speak to that because I'm the founder and CEO of Keiretsu, but I also lead the charge here in Northern California. The real estate's come to us. We've done about $300 million here as passive limited partners in a myriad of asset classes. When we see it, we don't like construction risk. We like things that are usually leased up. Let's say multifamily. If we get a multifamily project that has good collections, let's say between 95 to 100% good collection rate, maybe occupancy between 92 and 93. And we usually get between maybe a 12 IRR to 15%. But you are suggesting and getting, today I saw an opportunity that we can get an IRR exceeding 30% and a cash on cash exceeding 7%. But where's the risk? That apartment building, talk about that apartment building we saw today.
Let me give you a comparison, right? If you go into Seattle, as an example, and you're in South Lake Union, which is done spectacularly. You've got Amazon and the tech companies up there. There are cranes on every corner. There are apartment buildings going, Class A apartment buildings where rents are $3 and $4 a square foot. I mean, those are heavy, heavy rents, and there's a lot of jobs that are supporting those rents. Okay, but if you put up 10 or 15 or 20 apartment buildings that each have 400 or 500 units, and you're trying to get $3 or $4 a square foot, when does that end? Like at some point, that becomes very, very difficult to do. And those things are trading on 3% and 4% cap rates. Okay, the deal we're talking about, which is outside of Chicago, this is a suburban multifamily building that's 35, 40 years old, hasn't been touched on the interior in 15 or 20 years, and rents are 35% below the median rents in that area. So when people are buying property, a lot of it is making money on the buy. Right, so targeting specific areas, targeting specific properties where the rents are low, and the rent's going in at 93 cents a foot, and then upon renovation, rents at $1.20 a foot, which are still below the median rental rates in that particular area. So let's say there is a recession. This is workforce housing. I mean, maybe the rents go down, but they're not going to go down from $1.20 to 50 cents. I mean, the odds of that happening, in my judgment, are very, very slim. So you're finding things that just have, at least in my opinion, more mitigated risk on the downside, but also have upside opportunity, maybe not upside opportunity where they're going to double in value like they might in the Bay Area or in California, but still plenty good upside, but mitigating the downside risk.
I've been a happy investor in real estate over 40 years, and when I saw that opportunity today, and fortunately that's completely sold out, but that particular opportunity, I asked the entrepreneur, the GP, I said, tell us about your debt, because you can get stuck with debt. Let's say a recession happens 3 years now. But he has Freddie Mac debt, 10 years, what I heard.
Yeah,
and this particular opportunity, 98.5% collections, which is good, because you start looking, what's wrong with this deal? Okay, are they collecting? Are they? And then you say, well, gee, if the market, i.e., the tenants, getting back to your example in Seattle, if Amazon, starts going declining, and obviously the salaries decrease, then obviously the rents have to decrease. So what do you think? You obviously, your background is about risk. You understand risk. Where are we going in America? This is a big general statement here, and that's where we go, the secondary, tertiary markets. But in the primary markets, should we be putting our money in the bank, or should we putting it? What do we do?
I'm not a big fan of putting money in the bank because they don't pay anything. I think that finding investments in the real estate sector that are not correlated to the equity markets, which are increasingly difficult for people to figure out. I read an article in the Wall Street Journal the other day talking about how everything's going to traded funds, and being the stock picker is becoming a thing of the past. In the real estate space, one thing I've always liked about real estate is you can look at the numbers and you can see fundamentals. It costs so much money to build it. It costs so much to rent something. And all the math ties back together. And when the math stops making sense, that's really when you shouldn't be investing in that piece of property. But people tend to think in markets like this that it's just going to continue to go up and up and up. And then developers will hit home runs on deals because they timed the market well. But if you get started too late in the cycle, which I think is now happening, particularly multifamily would be a sector that I would be nervous about in certain markets, less so in certain submarkets. I take the approach that I don't think there is like a real estate market. There are a lot of small submarkets in real estate all over the United States, and even in different categories of real estate. So for example, we have a lot of entrepreneurs who are buying distressed debt. Okay, well, that was big business back in 2009 and 10 when people were trying to get rid of fire sale, right? People were under duress, having to sell assets. A lot of people were doing that. That didn't materialize as much as they thought it was going to around this time because of all the CMBS debt that came due, and the market seemed to recover pretty well. But when the market now turns the other way, that business starts to come back. So there are people who have done that for years and years and years, who are really good at what they do. I want to know who that person is so that when the market does turn around, I already have access to that person so that we can invest alongside that individual. So I don't feel like real estate necessarily, obviously making investments in today's market is challenging because there's a lot of money chasing deals and chasing yield. But as the market starts to cool off, I think you're going to see, it's not that there won't be some pain for certain people, but there will also be opportunities at that time as well.
Okay, so this is 2 segments. We have a very short time to finish off. Now we're going to talk about asset classes. What you like, Matt Burk, CEO of Fairway America, out of Portland, and I'm out in the Bay Area. What you like in America as far as asset classes, areas, sponsors. We can't name names, but also I want to know that you believe in these sponsors. You're putting skin in the game. Is that correct?
Oh, yeah.
Fantastic.
Of course.
Good. So it's great having you on the show.
Now, it's great to be here.
Now what we're going to do is drill down on more risk and more opportunity in 2016, 17, and beyond.
Sounds good.
Thank you, Matt.